Sunrun, a home solar power company that's about to sink faster than the Titanic.
We're gonna make it, Rose! Trust me!
I trust you!
There's a fast approaching iceberg, and the captain seems reluctant to turn the ship. We all know somebody who's tried to pay off credit cards with credit cards. Would you want to invest in a company like that? Sunrun has two massive problems ahead. Let's find out what those are. Sunrun has two massive problems: a mountain of debt and rising interest expense. Just how deep is this hole? As of the latest quarterly financials, Sunrun has over $12 billion in debt. Yeah, that sounds like a lot already, right? But check this. Almost half of the S&P 500 has less in revenues than that. When we compare $12 billion in debt with Sunrun's market cap of almost $2 billion, that's a big problem. It means there's 6 times more debt than the company's market value. To further compound this weakness of the balance sheet, we see only $1 billion in cash. The balance sheet tells us that the company has over 12 times more debt than cash. If all your future profits have to go to debt, how can your company grow? Remember, Sunrun has never produced $2.5 billion in revenue, and they have to pay that much in debt.
Sure, I'll just put it on my credit card. I'm never gonna pay it back anyway. 'Cause I have $30,000 in credit card debt.
And to sweeten the pot, in 2026, they have another debt payment of $1.2 billion, according to the latest 10K. That's a frightening future if I've ever seen one. But wait, there's more. Interest expense. We use the interest expense ratio to tell us when a company has too much in debt payments. The ratio is simple to calculate. Divide operating income by the interest expense. The higher the number, the better. For example, let's say we have a number of 5. A number of 5 is a good number because it tells us that a company can cover their interest payments with 5 times their operating profits. What's Sunrun's interest expense ratio today? Minus 0.7. Come on, man.
Come on, folks.
Interest expense is the interest on the debt, and for Sunrun, it's rising at an alarming rate. In 2023, the company paid $653 million on $2.2 billion in revenues. That's 30% of revenues, and it's rising. The problem for Sunrun, besides the rising interest expense, is the rising interest rates on their debt. Over the past year, those have grown over 1% or 100 basis points, and will continue to put pressure on profits, which all spills down the financial statements. Combine the high debt levels with the high interest expenses, you have trouble brewing for Sunrun. So management must be concerned with reviving the business, right? Turning around the ship. Maybe analysts are trying to help them, direct them, show that they're concerned. No. They're actually not. The solar energy gets a ton of hype. It's been a hot area of the market for years. Despite the hype, Sunrun continues to see declining revenue growth. You would think that this would concern management, yet looking at their latest earnings call and slides, there are 0 mentions of revenue growth and the fact that they continue to see declines across the board. They only mention revenue 7 times in the earnings call and really have no answers for why it's trending in the wrong direction. Just how concerning is this? Well, all signs point to Sunrun having no moat and 0 pricing power. That's a big problem. Let's examine why. Gross margins are not doing well. This means that as revenues decrease, Sunrun's costs are not decreasing with them. The company could be slashing prices or costs could be growing faster. That's an especially bad sign in today's environment. I mean, the costs of solar panels have decreased 90% over the last decade. You would think that this would accrue to Sunrun's profits. But it gets worse. As revenues are falling, Sunrun continues to increase their marketing and sales costs. That puts more pressure on margins and profitability. So revenues are heading in the wrong direction. Profitability also heading in the wrong direction, which is all bad news. It's all bad.
No, it's bad. It's all bad.
But there has to be light at the end of the tunnel for Sunrun, right? Right? When I dive into Sunrun's financials, the first thing that jumps out to me is the lack of profitability. The company has a long history of unprofitability. Investing is hard enough, so why buy unprofitable companies? And if we look for management guidance or clues, they don't provide many answers. After listening to the latest 2 earnings reports, neither management nor analysts discuss items such as revenues, margins, or returns. So where do we turn? We can turn to the company's 10K for answers, right? Well, kind of. Here's what it says. Sunrun has 3 main avenues for income: One, they sell subscriptions for their solar energy systems, which includes panels, installation, and batteries. All of these are contracted at 20 to 25-year time frame for nice recurring revenues. And they are growing these subscribers, which is great, a 32% CAGR. Next, they earn revenues from the sale of solar energy systems. These include panels, parts, installation, things like that, also sold on 20 to 25-year contracts. But the next part is where the mix gets fuzzy. Sunrun also sells the rights to these solar energy systems and revenues to investment funds. These investment funds in turn pay Sunrun cash in the form of non-recourse debt. Real quick, this debt leaves the debtor on the hook for any default, but provides Sunrun with flexibility and cash. This is how Sunrun has chosen to fund its operations, using debt. In fact, on page 70 of the 2023 10K, the company states, "Our business model requires substantial outside financing arrangements to grow the business and facilitate the deployment of additional solar energy systems." They say, "However, in order to grow, we will continue to be dependent on financing from outside parties." This, combined with the lack of discussion about profits or revenues, tells me the company is all about taking on more debt, which is the only way they can fund their operations and grow. You most definitely don't see this every day, and I am shook at how the company is ignoring basic fundamentals and continuing to take on more debt. The CEO and CFO discussed throughout the earnings call their plans to increase cash generation. It's a fancy way of saying they will use debt to finance their operations while the company burns cash through operations. But the most troubling thing for me related to this debt pile is the rate at which it's growing. For example, in 2023, the company had $988 million in cash on the balance sheet compared to $10.7 billion in debt. That's a 10x difference. This chart shows that debt is growing at a 43% annual rate compared to cash at only 19% annually. This is not sustainable. How will management address this? Again, we can turn to the Sunrun 10K to try to find more clarity. We see metrics like solar energy capacity, customers, and subscribers. Those make sense. Then they hit us with gross earnings assets. What is that? Does anybody actually understand this gibberish? It doesn't feel as nebulous as community adjusted EBITDA, but it's probably close. You remember WeWork? That's the feeling I get. Sunrun's business model is built on debt, debt, and more debt, while retail investors are left holding the bag. As investors, how do we prevent disasters like these from our portfolios? Easy, 3 simple ratios. Let's put 60 seconds on the clock so that I can teach you how. Bad stocks are everywhere in the stock market, but you don't have to buy them. Using 3 simple ratios, you can filter out the companies which end up hemorrhaging portfolios. The first, interest expense ratio. We discussed that a moment ago. Look for anything above 5 or higher. The higher, the better. Second, look at the debt to equity ratio. This ratio compares the company's total debt load, which is long and short-term debt, to the business's equity, what we as shareholders own. The lower the better on this one. Anything under 1 to 2 is ideal. Thirdly, the current ratio compares a company's current assets to its current liabilities. Anything above 1 is ideal. These simple ratios should be a part of your screening process to help you avoid bad investments. None of these will tell you conclusively that a company will go bankrupt, but they can help you avoid potential bankruptcies. And as the OG buff dog Warren Buffett said, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So what's the deal? Is Sunrun going to go bankrupt? I really don't know. My crystal ball, it's all cracked and cloudy. The signs we highlighted today are good indicators of the potential for bankruptcy, and Sunrun has all of those in spades. Avoid these kinds of companies at all costs. Why waste your hard-earned money on companies that can't even make money themselves? Avoiding investments like Sunrun is what we do at Value Spotlight. We dive deep into the financials, pulling out key insights to give you a competitive advantage and help you avoid money-losing investments. With Value Spotlight, you get a complete toolkit for smarter investing. I'll see you there.